Well, thank you so much for having me here today, Dave. And what we're going to get into is kind of what I call confused into confident. So we're going to look at, what option strategies to use to kind of play and dominate any kind of market. So it gets kind of confusing, and it's what I call the option at OSC, so option strategy confusion. So we're going to go through that today. Hopefully this will make things a little bit more clear for everybody as far as the different option strategies that you can use. So the following webinar here today is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. So, when we look at the, options, it really comes down to knowing what option strategy to use in the right option or right circumstance of the market. So we're going to start out with just kind of what, I kind of put together a brief option guide. We'll go through that, and then I'm going to show you some different option strategies to use and kind of examples of when to use these kind of strategies. So first off, the step one is really you need to know how option pricing works in order to maximize your option, trading profits. So when it comes down to pricing an option, the most important option factors for the components that go into option price or the value of the option is to understand the concept of time, and then also volatility and the impact that it has on the price of your option. Now, time decay always is going to work against a buyer, and it's going to benefit the seller of options. And the reason for this is that we look at the Greek called option theta, and that measures time decay. And that's going to either have a value that's either going to be a positive or a negative value. So all long stock options, if you're long a call, let's say, or a put, they're going to have a negative theta value, and that's going to indicate that you're going to lose value as expiration draws near. Now, the other side of that is if you're short that call or short that put, you're going to have that positive theta value, which is going to indicate the position is gaining value as expiration draws near. So you're gaining the value, that premium's going into your pocket, and that's going into your favor. Now, the other really main, component of price is volatility. And the implied volatility component is expressed as a percentage of your stock price, indicating basically a 1 standard deviation move over the current duration of your option cycle. So in theory, a stock should end up within a kind of a 1 standard deviation range of its original price about 68.2% of the time during the option cycle. Now, this is theoretical, but forecast, but it's part of what you should know to start out any option trade. So this is the first thing we do for all trades that we're using options on. We want to know, okay, what is a theoretical forecast of where this could go during this options series or option duration. So if we look at this kind of table here, this kind of will illustrate how these numbers flow through. So, every Thursday we get a new weekly option series. And so on that first Thursday, that first day, we're going to have 100% time in that option. So tomorrow, we'll have new option series that will be weekly options. Now, we look at the option component. We have time value times the implied volatility times the underlying security value. I'm going to leave this at a constant of 1. That gives us the premium or the option price. So in this example, the first day, let's say tomorrow, we're going to have a new option series, and we'll have 100% time value times implied volatility. I plugged in a number 300 and left the underlying security value constant. So you can see your premium is $300. Now, this is working each and every day, and you come back in after the weekend on a Monday, you can see your time value component has been cut in half. So even though in this example, I, plugged in and increased the implied volatility to 800, the premium really only went up to 400 from that, original premium of 300. So you can see that the impact that time and volatility has on the value of your option. And at the end of the day, at the end of the cycle, both time value goes to 0 and the implied or volatility go to 0. And so that option would become worthless. So these are things that are really important to understand, the components, how price works, and then that you're going to be able to, know better which option strategies to use. Now, the second step is to understand trading time. And with options, we can actually trade time by selling time to take advantage of the option time decay or theta. So by selling an option, we are in essence selling time and volatility. And you can kind of think of it as like a coupon that you get at a store. You'll see a redemption value. It has to be used by, maybe this next Friday or 2 weeks out. Otherwise, it's going to be no longer, valid. So that's exactly how an option is. You have these certain option series, and at the end of the day, at the end of their duration, they're worthless. They're no longer has any value to them. So that's very important. So here's a kind of a time graph to illustrate that. So the main thing, like in this example, let's say we go out 120 days, or even 90 to 120. When we go way out in time, the time decay is very, very small. Very kind of not noticed at all. And sometimes you may hear the gift of time is for the buyer of the option. Now, as we get closer into day 0 where it expires, about 30 days out is when things really start to get accelerate as far as time decay. And now, we have daily options, we have weekly options. So there's a lot of different option strategies that we can take advantage of to take advantage of this accelerated time decay, which, again, at the end of the duration period is going to be 0. So these are important things to understand when you're trading options. Now, many option trading strategies also are going to look to sell out of the money options on top of buying at the money options or maybe in the money options. And they're going to do this in order to offset that negative theta value that we just talked about. So this is going to result in a lower rate of time decay, but it also is going to lower your capital at risk that you're putting up on any trade. So, if you've ever done a vertical bull called debit spread, that's going to be one where you're reducing some of that theta decay by, selling a call against it, an additional call. Or if you've ever done a vertical put debit spread, it's going to do the same. So you've got a call debit spread, you sell that call here, that's going to reduce your theta decay, but it's also going to reduce your capital at risk. And the same for a put, debit spread, or even a butterfly, even more so, or what we call the long call condor, the same thing. So these are some structures that you can really gain some value to your option trading by understanding, how they work and then when to use them. Now, the next thing, step 3, is to understand the probabilities, trading the probabilities, kind of what I call the market maker secret. So option, markets use market probability statistics for pricing out the movement of your option into its expiration. So by knowing the probability of your underlying security or stock finishing within a certain range or price range at expiration, this really becomes key to determining then what options to buy or sell and what option strategy you should use. Now, this forecast is referred to as what we call the implied expected move or the implied move of your stock. And it's just an estimation of about a plus or minus 1 standard deviation move over the underlying security period, into its expiration. So it's kind of basically a normalized move, how far up or down it can move, during that duration period of that specific stock. Now, here's kind of an illustration on Thinkorswim platform. So this is where we can use the option deltas to give us probability. So in this example, I've got Apple and it's trading $190 basically. And if you look here at the 190 strike, that's at the money. So you look over here, it says a delta of 0.52, and this here is probability out of the money. So if you were to buy that 190, let's say call strike here for $6, you're paying that $6. You've got to basically with that delta of 50, it's kind of like a 50-50 chance that it's going to either be above 190 or below 190. So 52% probability. That's kind of how you can read it. And that's, what's called the probability out of the money right there. You can see 50.86. So as you go further out though, let's say we go way out here to the 217.5 strike, you can see your delta on that is a delta of 0.04. And you can see this here probability out of the money says a 96.59. So in other words, your probability of the price being at the money here at 217, there's basically a 96% probability theoretical that the price will be below 217.5. Or you could look at it and say there's only a 4% chance for it to be at 217.5. So we can use these deltas and things like that to quickly assess probability of a price being reached by its expiration. Now, the next step is selecting the perfect option strategy to take advantage of these various different things that derive and value the option and how to use it. So some of the go-to option strategies that I like to use based on what the market cycles are doing and market conditions are going to be the long call or long puts, okay? Or we can do the vertical debit spread, vertical credit spreads. The butterfly spread is a really good one. The long condor, the calendar diagonals are fantastic. The option collar and the synthetic long. All right, so these are all the different strategies that you can, kind of go to based on the current market conditions you're trading, things like that, and other factors. So we're going to go through and kind of, go through these each and look at the overall kind of conditions and how they work, and then go through a few examples to hopefully clarify, how these things work. All right. So first off, long calls or puts. Now these can be used, for any of your day trades, or they can be used swing trades. So these swing trades are, what we define as a trade that can last anywhere from 1 to 10 days, something like that, for about 2 weeks. And they can also be, long-term trend trades as well. Now, generally, when we're going long a call or put, we'll go, either the 50 delta, which is, at the money, or we'll go a little bit deeper into it, like a 70 delta strike. So that also reduces your theta a little bit as you go deeper in. So these are defined risk trades with unlimited profit, to the upside, which is great. But they're going to have, quite a bit of time decay, when you go long calls or puts. Okay, so they're really a decaying kind of asset. Now, the next one, though, is your vertical debit spread. So this is going to be one where, let's say you bought that call here. Let's say we do a call vertical debit spread. We can reduce the theta and reduce that capital by creating this vertical debit spread. So let's say we wanted to do that. All we do is sell a call against it. Maybe, sell a call above, further out of the money here. So we've got that long call we maybe started with. We sell a call here. It's going to reduce our theta, and it's also going to reduce the capital at risk. So these can be used for, our swing trades, or these can be used for longer term trend trades as well. But they're great because they are defined risk. So debit paid will be your total risk, lowers your capital cost that you're putting up, lowers your time decay, and but the profit upside is capped. So you've got a downside cap as far as the loss, which would be your debit paid, and your upside is capped. But these are great strategy, to typically you can get 1.5 to 2 to 1, maybe even 3 to 4 to 1 when you're doing vertical debit spreads. So these are spreads that we do a lot of at Power Cycle Trading. Now the other one, which is really great, is the vertical call or put credit spread. And so these can also be used for your day trades or swing trades. Best used when your implied volatility is higher, because as implied volatility expands, that increases the premium that you get from an option. So if we have a higher implied volatility, we're going to be getting more premium for selling that option. Because they're a credit spread, they're going to be defined risk, takes advantage of your time decay and any sideways price action of the market. All right, so these are really popular to use when you're kind of more in a range-bound market, just churning sideways. You can do these credit spreads. You can do it to create what we call the iron condor, where you're long, not long, but short a bear call credit spread with a bull put credit spread, kind of getting that double premium. All right, plus you can leg in, leg out. So they're a really good flexible kind of trade strategy that you can use. So these are kind of where to start. And then the next ones that we go into, well, I'll show you here a few more in a minute. But when we look at the vertical call debit spread, this is a positive risk ratio kind of trade, what we call positive risk ratio. So for in this example, you can see, let's say we're long here, the call, this 10-10 call, and then we're short here, the 10-20 call down below, okay? So that's kind of our risk profile. Now, this is done for this a debit cost of $300. So that's the maximum that you could lose would be $300, your debit cost. All right, so the spread width, and if you look at this, your 10-20 minus 10-10, that's a $10 wide spread. Remember, one option contract is equivalent to 100 shares. So this would be like a $1,000 wide spread. Now the cost of the trade is $300. So the potential profit is the difference. If we go out at expiration at that 10-20 strike, or above, that's capped there, our profit would be $700. And on that risk of 300, that's a 233% return. Or you can look at it as you're risking $1 to make $2.33. So it's a positive risk ratio. You're getting more profit than what you're risking. So these are really great, positive risk ratio trades. We typically look to at least get 1.5 to 1. So if you risk $1 to get at least $1.50. Now, when you do the vertical credit spreads, though, these are what we call a negative risk ratio trade. And you're going to see here in this example, let's say you're short this call, this 1020 call here, and then to cap the upside risk in case it keeps going up, you buy that upside call above it, the 1030 call. So again, this is a $10 wide spread. So $10 or $1,000 wide spread. You received $200 premium. That was your credit received. That would be your profit if it expires below that 220 strike. All right, so you're short that 220, and as long as it trades below that at expiration, you would keep the 200. But that $1,000 wide spread, you've got 200 credit. The difference, though, is your potential risk. So in this example, you're actually putting up $800 in margin in order to do this trade to bring in 200. So this is what we call a negative risk ratio. You're risking $4 basically in order to make $1. Now you're probably scratching your head if you've never traded options or credit spreads and saying, well, why the heck would I risk 800 to make 200? Risk a negative risk ratio. These are what we call probability type trades. So typically what we'll do is if we were going to, like, for example, selling this 1020 strike, we would look at maybe a 20 delta or less, 20 delta or 17 delta. So what that is telling us, that if I sold this 1020 strike here and at a 20 delta, then one way to look at it was, one delta is equivalent to 100 shares. So we start out with a delta of 100, and if we shorted, that was our short strike there, a 20 delta, then you can see the difference is 80. So we have an 80% probability that price will be below 1020. So that's why the risk reward ratios are, a negative in these types of trades, because you've got going into the trade a theoretical probability here in this example of 80% chance of winning. All right, so those are things to understand for credit spreads. But what I like to do is combine, the credit spreads with debit spreads, and with that we can construct a lot of different types of great option strategies. First off, one is really popular that we do is a butterfly. So a really unique strategy which combines buying and selling options, the vertical debit spread, and then combining a vertical credit spread to it. Now these will be defined risk, your debit paid, takes big advantage of your time decay and that implied volatility. No theta decay, positive theta, no time decay. Great for directional kind of a swing trade 1 to 2 weeks out. And these are also great for what we call pinning trades. And so of all the different option spreads, the butterfly will give you the highest return on capital at risk of any options spread strategy. So also great for a hedging trade, because you can leg in, leg out. So here's your typical profile of the butterfly. So you can see here in this example, we're long here the 10 strike call, let's say, and then we're short the 1020 right there. And then if we short another 1020, we've got, that's the body of the butterfly. And then to cap the upside risk, we're long that 1030. So this would be a butterfly, $10 wide, long the 10 call and sell twice the 1020 and then buy that 1030. All right, so this is your typical butterfly. That's the body of the butterfly, and that's where your max profit is. We call that the top of the tent. So in this example, let's say, earlier you saw that the $300 debit, and then you brought in a $200 credit here. So you put that all together in this example. If you did this, you reduce your risk down to $100. So you had that $300 debit cost there of this debit spread, and then you brought in 200. So now your risk is $100. But if you went out at the top of that tent, potential profit, or the profit is $900, $1,000 wide spread, less your reduced cost to 100. So your profit potential is 900, which would be a 900% return. or anything in between, in that area. So these are a great strategy to really reduce risk, but also get really levered up return. Now, the other one that's great is the long call condor or the long condor. So this is very similar to the butterfly, but what we do with this one, we can widen out the profit zone. So it moves the vertical credit spread side out. All right, so it gives us that bigger profit zone. So instead of being like the butterfly where we have that tight thread needle here, we'll move the zone out. So we'll move that credit spread out. So we'd be long that call debit spread, let's say here, and then short the credit spread further out, giving us a wider profit zone. So these are going to give us good positive return, also great for hedging, also positive theta. So really great trade structure. We do a lot of these, especially in higher volatility markets, the butterfly and the condor. When you get high volatility, they reduce your risk, but also can provide you still great returns. So that's what that looks like there, the risk profile. Now, the next one, this is one that we do a lot of these as well. These are a really great strategy, the calendar diagonal. So this is one we can use with calls or puts, calls for the upside or puts for the downside. So it's kind of a favorite medium to long-term directional strategy for speculation on a trend, trending up or down, and great for hedging. So basically, it's a vertical diagonal debit spread where you have the long dated option price. The long leg is further out in time, and the short leg is closer in, because that short leg is going to have a faster theta decay. So you can really take advantage of that, of the accelerated theta decay from that shorter duration option. So great strategy. We use these for trading trades. I'll show you a couple examples here in a minute. The trade construction then takes advantage of that accelerated time decay characteristic of that front short dated option that decays at a faster rate than the back dated, long dated. So that additional vertical spread component, then that's what adds that directional element for your really great profits. So you're basically buying options at a discount, and the trade is also a net debit. So this is kind of the risk profile of what it kind of looks like. So basically, think of a call debit spread, let's say, where you're long that call, let's say, and you're doing this in this expiration series this week. So that, let's say, the 5 December. So you're long the call debit spread 5 December, and you're short the call. Long the call in 5 December, short the call. Now, what you're doing with the calendar is, instead of being long the 5 December, let's say, we could go out to the, I'm just going to put in here the 1 January. So we could go out to the January, or we could go out to February. We could do leaps. So we can go long way out in time, but still on the short side, we could be short this 5 December, this week's expiration or next week. So we get that accelerated theta decay, but we have that diagonal spread component where we can just roll the spread, sometimes called the poor man's covered call. I call it the smart man's covered call. So really great strategy to use in certain situations. Now, the other one that is really interesting and great is what we call the synthetic long option strategy. So this is another one that we'll talk about, which is where you can actually replicate the payoff of owning the underlying asset or a stock, let's say. And so all you're doing, you're going to be combining different option contracts to replicate the payoff of the underlying long security. So what this does, it allows you to gain exposure to the price movement of your underlying stock while requiring lower initial investment capital compared to actually owning the stock outright. So it'll do a fraction of the cost. Then you can put that other cost in some other assets if you want, rather than having all your apples in one basket. You can really diversify out. So we're also a great strategy for covered calls to own the underlying at a much cheaper price by being a synthetic long and then selling calls against it. So a really great strategy, and one that can really pay off for your trading portfolio. So let's go through a few examples here. So what I'm going to cover here, since we don't have as much time as I'd like, but we're going to go through a couple of examples. We'll go through a really nice butterfly spread example, the calendar diagonal, and then a really cool synthetic long with a protective put strategy. Now, these are trades that we did at Power Cycle Trading that were part of our alert service trade or in our trading room. And so these are examples that of trades that we've done, and currently we're still in one of these as we speak. So here's an example of a butterfly, a wide wing put butterfly on QQQ. This was looking for a downside move, shorting QQQ, but doing it with a butterfly, very defined risk. So in this example, QQQ was trading at 314.60. We were looking for a potential downside move into this area here. This 50 simple moving average was coming in right about 304. So that was kind of the target for the butterfly. All right, so that's where we're going to set the target. That's going to be the body of the butterfly. And so you can see here the structure. We went out, it was trading at 314.60. So we're targeting that 304. So we bought the 314 put, sold the 304, sold the 304 again, bought the 294. So this is a $10 wide spread. You see $10, so $1,000 wide. The cost of this trade was $2.10 or $210. So the potential profit, if it goes out at the top of the tent, would be $790. Okay, right there on that risk of 210. That would be a 736% return, risk at $1 to make $3.76. Now that's a wide wing. Now we've done butterflies, pinning butterflies where we've actually made over 1,000% or more. But you know, if I had more time, I'd show you those. So here's where that trade went out. You can see the profile went out trading right here. You know, not perfect, but very close. And so this went from, you know, when we got in was what, 314, and now it's trading at 306.17 at the into the expiration. So the spread blew from 210 to 782. So there's our profit. The spread at 782 less our cost. Profit of $572. That's one spread. So if you did one spread, 572. If you did 10, over 5,000. 272% return there. Much better than if you did the shares, right? If you did the shares and you hit this point, you made 3.6%. So time decay is in your favor, your advantage, volatility collapse, and very high return on your capital at risk. So that's an example there. Now this is one that we still currently have on. This is a Walmart. We did this as a long call counter diagonal. And this trade, it was an alert trade that we still currently are in. So I took this picture just this morning to show you. So we set this trade up on the 25th, right here. And it was trading, Walmart was trading at 105.50. Now today, a little bit earlier today, Walmart was currently is trading at 114.14. I'll show you. But earlier today, it was trading right here at 114. So we got in right here, perfect entry. These are my momentum indicators that I use. Got in here, this break above this moving average. Beautiful trend. We're still in this trade. We still have another week left. And so this morning, this trade was now, we did a couple adjustments to the trade. And now the trade, we've got an adjusted price of basically $1.38, which is $138. Okay, so you can see that it's a $8 wide spread, and we've got $138 of risk. And earlier today, it was trading when it was trading at 113.98. That spread was at $542 or $542. So we were up $404 per spread, or 293% return. And that would be if you're, one contract. So you can just do the math. If you're long 5 or 10 or 15 or whatever, you can see what it is. Now this has a big, huge fat positive data. You can see $18 a day. So really, really nice there. All right, so that's what that looks like. Now the next one these are really cool. This is a synthetic long. And this is one that we set up on Google. And I'll show you where this is currently. And this was at the time using Leaps. So we set this up. This was set up. I set this one up back on the 15th of March, and Google was trading at 141.18. Now yesterday on the 2nd, it was trading right here where I marked the trade. It was trading at 315.69. So here's kind of the, what you look at when you look at this synthetic. It's like replicating the underlying shares. Now, the first part of this is if you're long the stock with the protective put, to show you the difference on this example. So here it is, this was being long the shares when it was down at 141.18 plus an under downside put at 110. All right, so it's called a covered call synthetic. So the cost of the trade, it was trading at 141.18, and our cost to do this was 148.80. All right, so yesterday this spread went out to 315.86. All right, so this trade was up. I'll just kind of go through here kind of quick. Was up $167, or for one option contract, $7 $16,700. Okay, pretty nice return. Okay, so that's a return of over 112%. But the other better way to do it was using the synthetic long with the put as protection below it. So here's that example. So this is where that put, this was going out using the 18 June 2026, and it was trading again. Here's where it was trading when we set the trade set was set up. And then yesterday, 315.76. So look at the value of this. The cost of this when it was set up was $21.18, or $2,118. And then yesterday, the spread had blown to 179.02. So the spread was, gain of $157.84, or times 100, that's $15,784, right? So right here, you can see that open P&L right there. All right, so that's the beauty of it. So if you look at then your return on capital, 15,784, the capital was $21.18, $21.18, 2018. That's a 745% return versus that covered stock position I just showed you had a 64.59, so 6.6 times more on this type of return. So these are just some really great strategies. If I had more time, I'd be happy to go through a lot more detail, but today was just the beginning. But what I covered, only you can see scratch the surface of what's really truly possible. So if you'd like to go deeper, I've got a really great course. This is now currently on demand. This is one that I did on all of these strategies. So it's my Ultimate Option Strategy Guide course. And so it's a 5+ hour course. Everything's recorded, broken down in 30-minute modules, plus I'm giving you another 6 enrollment bonuses. So if you use that link, it's only $197 today. And what you're going to get here is not only the course, which is, if you go to my website, powercycletrading.com, the course is for sale for $597. But today you'll get this course and all these additional bonuses for $197, so 67% off. But you're also going to get a 30-day trial membership to my PowerCycle Trading Club, which gives you access to my trading room open during the week, my Q&As, my after-market video newsletter that I do every day. So you're going to get that. If you stay on, that's $97 a month, or we have other different price packages, but you'll get that. You can start it whenever you want on this. Plus, we'll do a live full Q&A on this. We'll send you out a link, so you'll get that. Come in, ask questions, be live and recorded. Plus, you're going to get my option trading tutorial, another really good option guide, in what I call my option strategy manifesto. So this will be 15 different other option strategies that are really cool. And so you'll get that. Plus, you're going to get a price discount. So I do this course maybe once a year. So the next time I do it, you're going to get a updated live invitation to the course at a discount of $97. So plus my power tool guide. So add up all the different bonuses. We've got this total package of over $1,200, and today $197. So 84% off. Just use that link that I just showed you there, powercycletrading.com and /trade1. You should be able to just click on it or copy and paste. So this is what you're going to get when we get into the course, just kind of go through this. So first, I like to start out with the foundation of the option trading. So the Greeks that you really need to know how they work, delta, theta, gamma, things like that. And then part 2, we're going to go into which strategy to use when and where. And this is going to be based, I go through kind of my analytics of where we break down what is the market cycle we're in, up, down, or sideways. I also look at 5 specific chart patterns that we'll go through in the course, and what's the market condition. We quantify that. Is it high, low, or extreme volatility or uncertainty? These are all going to then determine what kind of option strategy to use, and that's what that's what I teach in this course. And then what's your duration? And then we go to the go-to option strategies taught in this course will be the vertical debit spread, the credit spread, the butterfly spread, long condor, calendar, and then the synthetic long with the protective put. So the course covers these 5 strategies in great detail. So it's a 5+ hour course because it's really extensive. And then 4, we're going to go through the risk management, how you can hedge using these strategies, what I call progression of hedging. which it then combines using the long condor defense and the butterfly defense. So a big part of the course is that. And then the resources in the course are what is, assignment, expiration, auto exercise risk, how to manage those. So it's a really very detailed, thorough course with a trading library. So, I hope that you will sign up for it. And if you do, then you're also going to get my 30-day trial membership, which gives you access to my trading club open during the week, 9:30 to 10:30, daily video newsletter. We do a Q&A every week, live and recorded. Traders Educational Vault, 50% discounts off of everything. And we'll do that follow-up Q&A. So that will be something to, after you've done the course, come in, ask questions, and then you're going to get my tutorial on the option Greeks, how delta, gamma, theta work. And then you're going to get my option strategy manifesto. What's a back ratio spread, or what's a long straddle, or what's a calendar, what's a ladder spread. So just a lot of great additional information here. And I'm so glad that everybody was here today. I appreciate the time I got to spend. I wish I had a little bit more, but I think the course will introduce you to a lot of things that you're probably were never aware of when you're trading options. And for $197, you're going to get a really thorough, very detailed course to teach you all of this and a lot more, plus access to my trading room to come on in and find out a little bit more about what we're doing at Power Cycle Trading. So any questions, I'd be happy to take. I've got a couple minutes left. And other than that, again, thanks so much for being here. And let's see, anybody have any questions? Oh, well, here's that Walmart trade currently. I'll just show you real quick so I have a little time. And this, again, this is one of our alert trades. So after a number of adjustments, now we're going to have to adjust this trade again today because it's now over our strike, that 114. So we'll do an adjustment here later today because we've got the trade out to 12 December next week. So what we'll do here is we'll adjust this to probably a call debit spread or call condor, and then we'll stick with this even another week. So we're going to, later today, we'll close out that 5 December short 14, and then we'll roll that up. And what we're going to end up with, we'll end up with a call debit spread for next week. We'll be long that call here at 108 next week, and then we'll sell something, we'll probably sell maybe the 118 or something like that for next week, and then probably convert it to a condor and probably recoup our full cost of the trade, making this a free trade, no capital at risk. So some really fun stuff to do, and these are the kind of trades that we look for, and it's what I teach at Power Cycle Trading. So again, thank you so much for being here.